Okay, good morning and welcome back, everyone, to our Tuesday morning market outlook session. My name is Tony Zhang. I'm the chief strategist here at Options Play. And last week we had a little bit of a roller coaster here with the equity markets. We saw a relatively strong market going into Wednesday night, which was the big earnings announcement from NVIDIA. And even though we had a somewhat tepid earnings report from NVIDIA with regards to the outlook that they gave for the next couple of years, equity markets held on to those gains for Thursday until Friday. We saw a fairly substantial pullback here led by technology. And I think this really reflects the valuations that the market continues to trade at and just how high they are. The S&P 500 touching 22 and a half times forward earnings, the NASDAQ 100 touching 28 times forward earnings. We're talking about valuations that are relatively close to what we saw during the dot-com boom. Not quite there yet, but on certain measures, if you look at price relative to sales versus earnings, we are already back at some of the levels that we saw during the dot-com boom. From earnings perspective, we're not quite there yet, but we're well above the historical averages with regards to the valuations that the markets are trading at. So I think it's reasonable for investors to be concerned from that perspective. However, I will say that the pullback that we saw here on Friday was very much "quote unquote" normal within the scope of the rally that we've seen, right? So we've seen a pretty substantial rally in the S&P 500 over the last nearly 5 months now, and this rally has largely gone unchecked. There hasn't been really any meaningful pullbacks to name of that generally would be seen as healthy for the overall market. The VIX is still trading just above 15%. We definitely still continue to see offensive positioning versus defensive positioning. But, we have seen energy and financials being the top performers here in within the sectors over the last week, with regional banks still leading the move higher here, while consumer staples and utilities continue to lag behind here. Now, this week is obviously a short week for trading because of Labor Day, but the big spotlight, I think, this week from an economic perspective is really going to be the Friday's non-farm payrolls, employment numbers. That is likely going to be a driver of whether or not we get that September rate cut. Now, unless the job numbers surprises substantially to the upside, I would say that the September rate cut is basically penciled in. But if we get a further deterioration in the labor market, which is what we saw in the week numbers from July and the revisions for May and June, that's really what could potentially change the expectations for the rest of the year. Right now, the markets are only expecting 2 rate cuts for the end of the year. However, we continue to get a slowdown in the labor market. That was what Chairman Powell during Jackson Hole spoke about, and what sparked, a commitment from traders to, expecting further rate cuts here for 2025. The labor market is really what could drive maybe 3 rate cuts for the rest of this year. So that's a big number, I think, for everyone to watch. That comes out Friday morning at 8:30 this week. On the earnings front, it's a very light schedule here as we head into the tail end of earnings season. We're effectively starting a new quarter in a couple of weeks. We have basically the airlines starting to report here. I'm sorry, we're not. We're still a month away from the next earnings season. However, we're at the tail end of this particular earnings season, and the only really one to probably talk about is, we have a couple of semiconductors reporting this week. We have some of the AI names like Zscaler that are reporting, and you have Lululemon, Dollar Tree, Macy's, giving us a better sense for kind of some of the retail side of things. That's really what's left here on the earnings calendar. So when we look at kind of the S&P 500, like I said, we've had this really nice rally here over the last 6 months after what has been a sharp recovery after the April sell-off here, and the markets have been kind of straight and to the up. We have started to see some level of exhaustion here. So as we make higher highs in price, we're not seeing as same higher highs on we're not seeing the same higher highs in terms of momentum. So for example, if you use RSI, you can see as we make higher highs in price, RSI is no longer making higher highs and actually making lower highs. Those are some signs of exhaustion here, and that would lead us to believe that we could get a minor pullback here. As you can see, 6,200 or 620 on SPY would be a reasonable pullback here to these specific levels, on just a little bit of defensive positioning and exhaustion here from buyers. So, any pullbacks here into the 620 level, I think would be buying opportunities for if the equity markets can stay held together here. If we break below 620, then things start to get a little bit uglier if we get below 620. But that's kind of where we're looking at right now on the S&P 500. If we look at the Qs, if we look at the Qs, you see the Qs very similarly recently made that higher high in price with that divergence, and this really has not quite made it back to those all-time highs. So technology right now is actually lagging behind the S&P 500. The amount of concentration that we're seeing here in the equity markets inside of tech is concerning. Overall, these were some of the levels that we saw during the dot-com boom in terms of just how concentrated the S&P 500 was within technology. So we've exceeded those concentration levels from the 2000s. So that kind of in itself leads to potential downside risk if everyone sort of heads to the exits at the same time, because there's so much crowding within just a few technology names. So that doesn't mean that we're going to get downside, but that just means that if there is some volatility and there is some downside, those moves tend to be more violent. They tend to be more they tend to be larger to the downside when you get crowding in such a few large tech names. So those are some of the things to pay attention to. 550 would be a reasonable downside target here on any meaningful normal pullback that we get in the Qs. We look at IWM, we look at small caps. Small caps for a while has outperformed the S&P 500 and the Nasdaq. So as you can see, over the last few weeks, the small cap has actually outperformed. And I think this really comes down to the fact that small caps trade at a much, much lower valuation than the large cap names. And that's why we're seeing a much more pronounced recovery in small caps versus the market cap weighted indices. And even if you look at RSP, the equal weight S&P 500 index, it's doing a little bit better here in the last few weeks. We don't see that same level of negative divergence in the RSP as we do on the S&P. And this, again, really speaks to the fact that the equal weight, where you don't have the same concentration risk within the S&P 500 is faring a little better in this type of market environment over the market cap weighted indices. And then if you look at kind of the bond market here, HYG, high yield corporate bonds, continues to move kind of straight up to the right, meaning the credit market is not overly concerned with regards to, where bond yields are, any concerns around, corporate credit that's not currently being reflected in the bond market. So giving us a clear buy signal, or rather a risk on signal here for risk assets. But if you look at treasuries, you look at TLT, it really hasn't moved much in the last a few months here, really. And the 10-year treasury yields remain kind of stuck around that 4.25 range here, despite, expectations for rate cuts. Interest rates have not particularly gone meaningfully down. And that's definitely one of the things I think is holding potentially equity markets from rallying substantially from where we are right now is really at the moment the bond yields. So looking at opportunities here in the markets, we have quite a few that's interesting, especially some new ones that I want to point you to. First one is Elevance Health. Elevance and United Health are the two largest health insurance companies in the US, and these stocks have struggled a lot in the last couple of years. As you can see, if you look at the year to 1 year performance here of these particular stocks, we're talking about a stock that was a $560 stock that bottomed here around 273, so effectively halved in value in less than 1 year. But there's starting to be some signs potentially that is starting to recover here. So if you zoom in here, you can call this potentially a bottoming formation that is starting to kind of show some upside gains. So it broke out above 300. It's continuing to trade above that 300 level here. If it can hold that $300 level, our upside target here is fairly substantial here to around 375. That would basically be the gap from the previous gap here from the beginning of July. Filling that gap is what we're looking for in terms of upside exposure here for Elevance. Elevance trades at around 10 times forward earnings, which is, compared to the industry average, a small discount. But if you look at growth expectations, we're talking about growth expectations that are pretty much in line with the rest of the industry, but Elevance is more profitable than the rest of the industry. So for those reasons, I think it's trading at a meaningful discount relative to the industry. And I think that's really where the technicals and the fundamentals have a nice alignment here on Elevance for a stock that really has struggled quite a bit here over the last few years. Looking at Gilead, this was a stock that was the hot stock 10 years ago, but the stock has really kind of taken a bit of a hit in the last decade or so, but has really climbed its way back up to its all-time high, which is around the 120 level here. And if you notice that this stock, as it kind of climbed back up to that 120 level, it broke out above that level and failed. But if you look at this from a longer term perspective, right? You have this uptrend that so far is still being respected, and that's kind of what I'm looking at. Is this pullback to this uptrend might provide a really nice risk to reward ratio for a crack back at all-time highs and potentially continue to move substantially higher from there. Gilead, if you look at growth expectations, head and shoulders above its industry in terms of EPS growth. Net margins of 22% is also well ahead of the industry median. Yet from a valuation perspective, it basically trades in line with the rest of the industry at around 13 times forward earnings. So with its HIV and oncology pipeline, this looks relatively strong here from a drug manufacturer. So the recent pullback here, I think, is an interesting opportunity to align the technicals with the fundamentals. As I said before, the regional banks, they have really been a driver of growth here over the last couple of weeks. And Truist Financial, which, these types of regional banks generally tend to benefit from a rate cut environment as they generally stimulate kind of loan portfolio growth. They also reduce some of the risk that these regional banks have with regards to commercial real estate. And just recently, as you can see, the stock broke out here above this $45 level here and is potentially onto a new 52-week high. Truist Financial trades at a pretty meaningful discount to the industry. It's only trading at 1 times book value, which is half the value of what we're seeing a lot of the stocks in this industry trading at. Yet growth expectations are actually far exceeds its peers. Revenue growth expectations around 17% versus 6% for the industry. Net margins are right dead center with the rest of the industry. So, when you're expected to grow faster, you're just as profitable, but you are trading at a valuation that's at least about a 20% discount to the industry. And you're heading into an interest rate environment that is favorable for these types of regional banks. That's really where I think you have an interesting trade setup here for Truist Financial. And there are a lot of banks with the almost the exact same technical setup, but Truist Financial is by far the most inexpensive from a valuation perspective, and that's why I've chose Truist over all of the other regional banks that have generated very similar buy signal. The next one I'm going to take a look at here is Copart. Not a household name. They deal in salvage auto auctions. So when you total your car and they have to write it off and essentially salvage it for parts, Copart is actually the company that takes on that salvage vehicle, breaks it down into their components and auctions off sort of the raw materials. So Copart, like I said, not a household name, but operates, globally across 11 or 12 different geographical regions that they operate in. And recently, as you can see, the trend has turned positive here. It looks like it's starting to bottom, and Copart trades at a reasonable valuation relative to its peers. It trades at 28 times forward earnings, which is a premium to its peers at around 20 times. But if you look at growth expectations, we're talking about revenue growth that's more than double what the industry is commanding, and net margins that are north of 32%, which is head and shoulders above the industry. So from my perspective, trading at a premium relative to the industry is not a problem from a valuation perspective, and actually still represents a substantial upside opportunity once you factor into the fact that it grows substantially faster and is far more profitable than its peers in kind of the business services industry, which is a pretty broad category, that they're kind of being lumped into. The next one I want to take a look at here is a REIT, PLD, Prologis. You're probably if you are familiar with them, you're familiar with them as kind of the logistics warehouse REIT, if you will. So think Amazon when they're trying to expand into a new geographic region and they need warehouses. In order to do that, Prologis is the type of company that they would go to for that type of logistics and warehousing capabilities. And the stock has kind of been sideways for quite some time here. About the last year or so, the stock has been trading sideways. It's been kind of in the sideways motion here for the last 4 months or so, but just started to break out here. And Prologis trades at a premium to its peers. It's trading at 22 times funds from operations, which is a better metric for valuations for REITs rather than price to earnings. So, which it trades at a premium, but that premium is also justifiable if you look at growth expectations. EPS and revenue growth, you're talking about pretty meaningfully faster growth expectations versus the industry. And what's really kind of interesting from my perspective is that Prologis is far more profitable than most REITs. Net margins are north of 40%. You don't see a lot of REITs kind of in that particular range, versus the average for the industry is around 25%. So when you look at the profitability, you look at growth expectations, Prologis recently breaking out above this 110 level, I think can easily target into the 125 level here to the upside in the short run. So it's not a big move that we're expecting here to the upside, but certainly a move that we are expecting. The next one I want to take a look at here is MasterCard. And we've liked Visa for a long time, but MasterCard recently has started to break out here to new 52-week highs. So the breakout here at the new 52-week highs, a small pullback here. We're looking to see if that pullback turns into more meaningful gains to the upside. Now, MasterCard it's not cheap. It's trading at 31 times forward earnings, which is definitely something that you have to consider when you're thinking about this from a valuation perspective. Growth expectations, I think, more than back up the valuation that it's trading at. You're talking about 13, 14, 15% EPS and revenue growth expected for the next few years. That's head and shoulders above what the average S&P 500 stock is expecting, or what the industry that it's in within credit services. but also net margins of 45%. Outside of Visa, there's really no other credit services that are generating that kind of net margins. So for those reasons, you can justify the 31 times forward earnings, even though on paper that looks quite expensive. We have quite a few of the medical device makers that I think are worth looking at, but we'll look at the BDX, which is Benedict Dickinson, sorry. Because this trades at 13 times forward earnings, and it recently has just completed this kind of, you can call it this bottoming formation that it's been in, this 187 level, right? So this kind of we're looking at this to at the very least fill this gap up to 202, right? So we broke out here from this kind of, call it this bottoming formation, broke out, almost reached 202, started to pull back a little bit here. And I think that's really kind of where your opportunity lies to get some further upside if you don't already have exposure to this particular name. It's not a household name. They make medical devices, but they're by far one of the largest globally. And they're trading at only 13 times forward earnings, which is a significant discount to the industry. Now, I will say that significant discount is because they're expected to grow slower than the industry and they are not as profitable as the industry. So, for those reasons, it is not as the valuation I think is lower because of that, but it is also at a valuation that's so attractive that there's still upside opportunity, even though this company grows a little bit slower and is not as profitable as some of its peers. The next one I'm going to take a look at here is Alphabet. Out of the major tech names, it is the only one that currently we have on our buy list because it is the only stock trading at, in my opinion, a reasonable valuation. And it's worth noting that it recently just generated a counter trend sell signal. And what that generally means is that just the stock has had such a spectacular run that there is a higher probability of a short-term pullback here in this particular stock. So that is something to be aware of, meaning buying the stock right now from a statistical perspective is not as favorable. But this is one where the type of stock where I think is worth putting on your watch list, because we wait for these kind of pullbacks to look at buying these stock. It was actually this particular pullback that we generated our first buy signal on this a few months ago. And the stock, as you can see, has had a really nice run since we generated that buy signal. And we're now waiting for the next buy signal. But at the moment, things are looking a little bit too overextended at the moment to look at buying fresh new stock at this moment, right? We're at 52-week highs. I'm sorry, we're at all-time highs basically for the stock. But I will say long term, I still really like this because Alphabet trades at only 20 times forward earnings. Look at all the major tech names, NVIDIA, Oracle, Meta, Microsoft, any of these guys in the AI space, they're trading north of 35, 40 times forward earnings at this stage, which is just hard to justify to some degree because, the revenue that these firms are generating from AI is not there yet. They're expecting that in the next few years, they're going to be able to start to monetize this and generate revenue. But at the moment, they're just spending cash like there's no tomorrow, in hopes that in the future that they'll be able to justify that cash spend with revenue. But, at the moment, we don't have real evidence yet that these companies will turn their heavy AI investment into substantial revenue. That model hasn't been proven out as far as who's going to be able to do that. So I think for those reasons, it's difficult sometimes to continue to buy Microsoft, Meta, and some of these other names at those valuations because it's fully priced in. You really have to have confidence in their ability to generate revenue to substantiate those valuations. Alphabet trading at 20 times forward earnings is much more reasonable from that perspective, so that even if Alphabet doesn't turn a huge amount of revenue from AI in a very short period of time, you have a valuation that isn't relying on that in order to support it. So that's why I really like Alphabet in the long run. And then looking at a couple of bearish ideas, Caesars Entertainment. This was one of the pandemic stocks that did really well during the pandemic, and it's just over the last few years have continued to tumble here. And I think that unfortunately their woes is not quite over. Trading around 33 times forward earnings, 34 times forward earnings, which is substantially higher than the industry, even though growth expectations for this stock is virtually zero. Net margins are negative, so it's losing money in terms of its operations. And the recent kind of rally that we've seen here, the small rally that we've seen, I think actually presents a sell signal. And that, as you can see, it generates a bearish trend following bear sell signal here. So basically continuing to follow the trend and looking for a continuation in that bearish move to the downside. And then Cintas, global, or rather corporate uniforms provider. So the type of business that isn't particularly scalable. As you can see, really struggled at the 52-week high around 225 multiple times here in the last year or so. We basically took that rally back into the 225 as a sell signal. As you can see, the stock has dropped a little bit since we've added this particular stock. It's starting to break below 210 now, which was the previous swing low. And I think that if we can break below this level, there could be further downside. Cintas trades at 43 times forward earnings. That's more expensive than NVIDIA. That's more expensive than Microsoft or Meta. Yet, if you look at growth expectations, EPS growth of 10%, revenue growth of 7%, nothing to write home about in terms of growth expectations. Net margins are decent at 17%, but also nothing, in my opinion, that would justify 43 times forward earnings. So that's why I think there's some further downside potential here for this stock. My initial downside target here is around 200, but I see extended downside targets into the 180 level, given the high valuation that it trades at right now. So those are some of the opportunities that we see here in the markets right now. Quite a few to the upside, but also a few to the downside that we're watching right now. So I think in this market environment where we're seeing a little bit of a concern around valuations, I think it's important to look at opportunities on both sides of the coin. With that, I hope this helps you and give you an understanding of how I'm viewing the markets from a macro perspective, and then giving you some trade setups here for the week. Thank you so much, and hope you guys have a great trading day.